Chapter 15, Part 2, Sales Type Lease with and without profit. Now we have again our lease classifications. We have the leasee. It can be a finance lease or it can be an operating lease. So, finance lease if it meets one of or more of the 5 criteria, operating lease if it doesn't meet any of them. The leaseor can be a sales type lease with or without profit, or an operating lease. Now again, we have our 5 rules. The 5 rules are: has there been transfer of ownership? Is there a purchase option? How long is the lease term versus the life of the equipment? What are the present values of the minimum lease payments? And if the asset is specialized or can be used by anyone. Now, a sales type lease with selling profit. It occurs when the fair value of the assets exceeds the cost of the carrying value. Leaseor recognizes a selling profit at the beginning of the lease term. Leaseor also recognizes interest revenue over the lease term. Key point: selling profit is the difference between the sales revenue and the cost of goods sold. Now, another thing to remember. From the leaser's point of view, when there's a selling profit, all leaser entries other than the entry at the beginning of the lease to include the selling profit are the same as a lease without profit. For the leasee's accounting is not impacted by whether or not the leasee recognizes a profit. The journal entries made by the leasee are precisely the same with or without a profit. Now, when we go through the criteria to determine if it is a sales finance lease, then we determine if it has, or first of all, we determine what kind of lease it is. Then we determine, is there profit? If there is profit, then what we're going to have to do is book cost of goods sold and sales revenue, and then also take the equipment off the books. If it has no profit, all we're going to do is take the equipment off the books and book a lease receivable. Now let's take a look at an example. And in this example, we have no profit. So Mike leased equipment that cost Danny $2 million on 1/1/2021. The lease payment was $130,550 paid at the beginning of each quarter for 5 years. That would be 20 periods, 4 times 5. The life of the equipment is 5 years and it has a fair value of $2 million. The implicit rate and leasee's incremental borrowing rate is 12%. What type of lease is it? What are the journals of the leasee and the leaser for year 1? So first, what information do we need? We need to know the cost. We need to know the time period. We need to know the years. And we need to know the fair value. And the interest rate. Now, first of all, we need to go to Annuity Table to get the net present value of the lease payments. So, what annuity table would we use? Well, we'd have to use the present value of an annuity due, mainly because the first payment is made when the contract is signed. So we go to the present value table, and N equals 5 times 4 is 20 periods. Interest equals 12% divided by 4 equals 3%. We go to the present value of annuity due, factor times the 130,000, and we find out it equals $2 million is the fair value. Since the cost equals the present value of the lease, this is a sales type lease with no profit. Now we go through our 5 steps determining the lease. So, does the ownership transfer? No. Is there a bargain purchase price? No. The lease term, 75% or more of the economic life, and it is because it's 100%. Present value of the minimum lease payments, yes, they are equal, so yes, it does meet that criteria because it's 100%. The underlying asset is specialized, no, that's not true, but since we met 2 of the criteria, we only need to meet 1, this is treated as a finance lease. So now let's look at our amortization schedule so you can see, because what you want to do is when you're booking the payments, what you have to do is figure out how much is interest and how much goes against the payable. Here is our table using what we would do is we start with taking, now the first payment is interest free because it's made, remember interest is earned over time. And the first payment is made when the lease is signed. So that first payment, the whole $130,516 reduces the lease payable. But the next payment would include interest. So what we would do is take our, so the next payment would, because what we're going to do is take $1,869,484 times 3%, and that tells us how much of interest is interest, and then we subtract that from the $130,516, and that tells you how much goes against the lease. So now let's look at our payments. Our first payment, first of all, for the leasee, we have to book the right of use asset. Then we have to also show our first payment. Our second payment would be cash, interest expense, and lease payable. That would be, and we're going to keep doing that until that lease payable becomes zero. Our second payment, of course, it changes because the balance goes down. But if you notice, the cash is always the same. Our fourth payment. Now, what about the end of the year? Well, we have to accrue the interest, and also, since we're in essence, we own this, we have to do our amortization depreciation. I don't know why they call it amortization, but we're going to amortize our right of use asset. And so we're going to take the $2 million divided by 5 years, and we're going to book amortization expense, right of use asset, because we're going to reduce that. So at the end of the 5 years, there should be no right to use asset, should equal 0. And the lease payable should equal 0. Now, what about the lessor side? Well, they're going to take the equipment off the books, set up the receivable, and then each payment, the first payment again, does not include any interest revenue because that's what it would be on their side. But if you notice, in this case, if you notice, our interest revenue is exactly the same as the interest expense. And we would do this for each payment. Now, we have to accrue the interest at year-end, interest revenue, but remember there's no depreciation expense because this is not on the books of the lessor. Now, what is going to appear on the balance sheet and the income statement for the lessee? Or let's do the lessor. Okay, they're going to show their initial lease receivable. They'll show it being reduced by the 4 payments, and so the balance at the end of the first year would be $1,639,425, and they would have recorded interest revenue of $210,672. Now, same problem, but what if instead we were dealing with a sales type lease with profit? So in this case, we leased equipment from Danny Company that cost $1.7 million. The lease payments are $135,616. And 5 years, quarterly payments, 12% rate. So let's go through this process. Now, step 1, determine if this lease with profit for the lessor. Well, the present value due factor, and we're going to take that times the payments. We get $2 million minus it, which is greater than the 1.7, so we have a profit of $300,000. Plus, we're going to have interest revenue. So what does that look like? Well, on the part of the lessee, the entries are exactly the same. There is no change. So they're the same ones we already went through. Now, for the lessor, the only thing that's going to change is that first entry, because we're going to have to book sales and cost of goods sold. All the rest of the entries are the same. Now, what is this going to look like on the financial statements? For the leaseor, what they're going to see is they're going to see $1,639,425 is the balance in their lease receivable. And on the income statement, they're going to see gross profit of $300,000, plus they're going to see interest revenue. That concludes part 2 for chapter 15.